Hello, this is Jody Trana with Chapter 9, Part 2 of Business Finance. Let's start out by reviewing this previous problem. The skills that we've learned in the time value of money problems from Chapters 5 and 6 will be used in these chapters to evaluate bonds. We learned the tools previous, now we're going to apply these tools to help us make decisions about investment opportunities. The first part of the questions ask what the yield to maturity is for this particular bond. The second part of the question asks what the value of the bond is today. That's the amount that an investor would be willing to pay for the bond. And finally, the third part asks, should you purchase the bond at the current market price of $1,100? So now we get down to the matter. The analysis of the bond helps us to determine whether we would buy the bond or not. We can also use the same type of analysis to figure out whether we should sell a bond that we're holding. Let's look at the analysis individually, starting with the first question. It's asking us to compute the yield to maturity on a $1,000 bond that has a current price of $1,100. Based on what we already know about the relationship between bond prices and their yields, we know that when a bond is being sold at a premium like this one, the yield to maturity is going to be lower than the coupon rate of 9%. So why do we want to calculate the exact yield to maturity? Remember that there are two future cash flow streams coming to you when you purchase a bond. First, you'll receive coupon payments for the time periods that remain until the maturity of the bond. Then at maturity, you'll also receive the face value of the bond, usually $1,000. We want to know exactly what we will earn as a return on our $1,100 investment. That rate will help us evaluate this bond against other investment opportunities. We start the process by building a timeline. This time we do it in our head, and we identify the components. We used to have 5 components in the previous time value of money problems, but now we'll be identifying 7 components. To the original 5 components, present value, number of periods, future value, interest, and payment, we add the coupon rate and the market price. These are all the components we need to assess this bond. Here we have all of our components identified. In this problem, our market price, the $1,100, and the present value are identified by the same number, but that won't always be the case. The coupon rate is also identified as 9% and is used to calculate the payment, which is the face value of $1,000 times the coupon rate of 9%. This bond pays interest annually at $90 a year. So coming back to our original problem, we have the answer to the first question. The yield to maturity is 7.14%. We were right. The yield to maturity on this bond sold at premium is indeed less than the coupon rate of 9%. We didn't know how much less, and now we know the exact yield to maturity on these 2 future cash flow streams. The yield to maturity tells us our return on our investment of $1,100. Now let's tackle the second part of the question. If we were to compare this bond to other bonds of comparable risk in the marketplace, those bonds, we're told, are earning 7% yield to maturity. If all other bonds have the market rate of 7%, what is the value of this particular bond that's paying 9%? Let's go back to our 7 components. Based on the question asked, what is the value of the bond today? We know that the missing component is the present value. So we'll start by replacing the $1,100 present value with a question mark. Now remember that there are a few components in the bond valuation problems that never change. The time or duration left in the bond may change as the bond is bought and sold, but in this problem it hasn't changed. The future payback at maturity of the face value of the bond never changes, so that's still our future value. Also, the coupon rate and annual or semi-annual coupon payment never changes. In this problem, the market price is staying the same as $1,100. That's the number we're going to have to evaluate because that is the going price of this bond. The other component that changes in this problem is the yield to maturity. 7.14% is the yield that we calculated based on the $1,100 present value. But now we want to look at how much we would pay for a bond that yields 7%. So let's change the interest component to 7. Using these components, we will calculate a new present value. This present value represents today's value of the two cash flow streams of this bond, discounted at the market rate of 7%. And the present value, or the price we would be willing to pay to earn 7% yield to maturity, is $1,107.78. So let's boil it all down. We're evaluating this bond that will cost us $1,100. It's selling at a premium because the coupon rate that pays out interest is higher than the yield to maturity of 7.14%. If we pay $1,100 for this bond, we will earn 7.14% return on our money. With just that information, we don't know if that's a good deal until we know how much we want to earn on the bond. That's Part B. Part B tells us how much other bonds are earning. Other bonds in the market are earning 7%. So if this bond was earning 7% instead of 7.14%, it would be worth $1,107.78 to us at 7% yield to maturity. In other words, we would be willing to pay $1,107.78 for the chance to earn 7%. Part C says, should you purchase the bond at the current market price? Absolutely. For $1,100, that's the current market price of the bond, we can earn 7.14%, which is more than the market rate of 7%. And the price that we would pay, the $1,100 market price, is $7.78 less than what we would be willing to pay for a bond that earns less. Here we have a bond that matures in 2 years, has a par value of $1,000 that we will receive at maturity, and pays interest payments semi-annually at a rate of 10% per year. Let's see how the value or price of this bond goes up or down based on the yield to maturity in the market. The value of the bond with the yield to maturity of 10% is $1,000. The value is the same as the par value because the yield to maturity is the same as the coupon rate. If the market interest rates go up to 15% yield to maturity, the value of this 10% bond will go down to $916. The value of the bond with the yield to maturity of 15% is greater than at 10%. If I can get a 15% bond, I won't pay a full $1,000 for a 10% bond. The demand for 10% bonds goes down along with its price. The bond is trading at a discount to par. If the market rates go down to 5% yield to maturity, the value of this 10% bond will go up to $1,094. The value of a bond at 5% yield to maturity is less than a bond at 10% yield to maturity. If most bonds in the market are earning 5% for a $1,000 bond, then I would certainly pay more for a 10% bond. The demand for a 10% bond goes up when other bonds are earning 5%. The bond will trade at a premium to par. Let's view the same information on a graph. Here you can see when the yield to maturity of bonds increase, their prices decrease. Or said the opposite way, when the yield to maturity of bonds decrease, their prices increase. That's because the cash flow streams haven't changed. The coupon rates and the maturity value, they stay the same. Only the expected or desired return on the investments change, and that's because of changes in the marketplace. Shown one more way, the relationship between the yield to maturity, those market rates of other investments, is inverse to the price of a bond. If you were holding a bond that was paying a fixed coupon rate of 4% and the yield to maturity dropped to 3.5%, that's all that's available in the market right now, 3.5%. Your 4% bond takes on a greater value and a larger price it will bring in the market. However, if you're holding a bond that was paying a fixed coupon rate of 4% and the yield to maturity, the market earnings rose to 5.5%, now all other investments in the market are returning 5.5% right now. Your 4% bond is worth less, and it will bring a lower price if you want to trade it. There's 4 key relationships in bond valuation that you can always count on. We're going to go through each one of these 4. They are the inverse relationship of yield to maturity to price, that bonds sell at premiums and discounts, that bond values adjust over time, and that risk increases with the length of time. The first key relationship. The value of a bond is inversely related to changes in the market's required yield to maturity. We've talked about this several times, but as the market's required rates of return increase, the market values of the bond decreases. That's to adjust for the non-changing cash flows of coupon payments and the par value. The second key relationship is that bonds sell at premiums and discounts. Discounts occur when the yield to maturity is greater than the coupon rate and the bond value is less than the par value. Premiums occur when the yield to maturity is less than the coupon rate and the bond value is greater than the par value. The third key relationship is that as the maturity date approaches, the market value of a bond gets closer and closer to its par value. The reason is because there's less time to collect the coupon payments or the interest, and more of the bond's value relates to the maturity amount, usually the $1,000 being returned. The closer we get to the maturity date, the less the coupon payments matter, and we're only looking to that payback amount, the par value. The fourth key relationship is that long-term bonds have greater interest rate risk than short-term bonds. This is because of the fixed nature of the interest paid with the coupon rate. If you were holding a 20-year bond, there would likely be a great deal of fluctuation in the market interest rates during that duration. That causes risk for your investment.